The big four banks have seen their reputations crumble under the weight of evidence from the Royal Commission.
Now, if you're in the finance space, share market, into banking, you care about your home loans and what the economy is doing, this has been the top of everybody's talk list for the past 6 months or so. And it's affected the share market drastically, with many bank shares falling down in terms of prices. But for the everyday person, this has really had no effect. None of my colleagues know about it, none of my friends know about it, nor do they really even care about it. But on today's video, I just wanted to touch base on some of the recommendations that have been made in the report. I did spend a couple hours just to read through the report, and man, it reminded me a lot of law school. But I'm looking to break down the major recommendation within the report that has everybody talking on the news shows and give you my thoughts from a conveyancer's perspective, having worked in conveyancing in the past and dealing with mortgage brokers in the financial industry, and personally as an investor, and what this actually means for the economy as a whole, and give you my thoughts on why I was still buying Westpac shares on the dip. So if you're in the share market, and in particular in the financial sector, which many of you in Australia would be, you would have known that the interim report had come out, which hit the banks quite hard in terms of their share prices. We saw dips of 7%, 8% for some banks in terms of their stock price, and also just a decline in confidence in the financial sector as a whole. That being said, it also presented a great buying opportunity for many people to get into the finance sector, because many of these banks were now yielding about 7 to 8%, and NAB at one point, when their shares were $22 a share, were yielding 8% plus. Now, the interim report and many of the talks were looking into the structure of the banks and how sales were made, that certain entities and individuals were incentivized to write up these loans that they know borrowers could not pay back. And upon anticipating for the final report, everybody was expecting something scathing, something much more bigger than what we were presented with, which unfortunately wasn't the case. Now, in my opinion, I thought the report was rather weak. There probably could have been some recommendations in terms of the structure of the banks and how lending was provided. In saying that, I also saw that the report was not going to affect lending much at all. Now, if you look at statements of Scott Morrison before the report has come out, he's mentioned that the easiest way to ensure nobody gets hurt is to lend nobody any money. But if nobody gets lent any money, then everybody gets hurt. So I think we have to be sensible. So that's our Prime Minister's way of saying that lending needs to be controlled. However, we can't go overboard and just not lend anybody any money, or restrict it so hard that nobody can get any money lent to them at all. Because what that does for an economy is it actually decreases growth. And if nobody's willing to lend money so that individuals can buy bigger items, and then boost the job market, boost the demand for materials and goods. Like, you think about it, if nobody wanted to buy houses in Australia, tradies would be out of jobs. There'd be no need to the supply of any of the materials and goods that actually build the homes, and there would be a lack of housing, which would then ultimately drive the value of people's assets down. Now, if you've been an individual who's been burnt by banks or been burnt by a broker before, I totally understand why you'd be frustrated at the lack of fundamental changes and structures within the financial institutions. But we have to remember that in a scope internationally, Australia has one of the most sound and stable lending formats, and all our financial institutions actually have a really high standard when it comes to lending relative to places like the US, if we look at examples in 2008. Now, in Australia, most people will have to have at least a 10 to 20% deposit, and most individuals generally do. Now, there are exceptions where you can have the 5% deposit, but most often individuals go into home loans with about the 10 to 20% deposit. And this is in comparison to the US, where you can go into your first home with a 3% deposit. Now, let's get to the report. One of the biggest things that everybody is talking about is that mortgage brokers will no longer receive upfront commission from the bank and a trailing commission from the bank. And that's something now the borrower will have to pay upfront for the services of the mortgage broker or the financial advisor. Now, there's a few reasons why the commissioner wanted to action this and saw this as an issue within the lending sector. First, we have to look at how mortgage brokers are actually paid. They're paid by the financial institutions that they write the loans to. And as a result, one of the 3 points of consideration that was put out in the report was that there was conflicting remuneration. In that, brokers recommending banks based on commissions being paid, and therefore the party paying the commission was being favored as opposed to the borrower. Now you can see how this pans out, right? So essentially, if CBA was giving a commission rate of 0.65%, let's just say, trailing, and their upfront commission of, I don't know, $600, as opposed to maybe a smaller bank like ME Bank, who might be providing an upfront commission of $250 and a trailing commission of 0.4%. Now, if I was a broker, you could easily see where I would be getting the client to apply to. And to understand what a flex commission is, we have to look at what the trailing commission is for the broker. So the broker gets paid, like mentioned before, an example, as 0.6% on a loan that's been provided to the borrower. And if the broker can convince the borrower to take on a loan that's higher than the fixed rate percentage. So for example, if a fixed home loan percentage was 3.9, if I could convince a borrower to take on 4.6% instead, as opposed to a 3.9 for their home loan, I would then get a percentage of that difference. Now this percentage can't proceed higher than a fixed rate that the lender provides. So for example, if the lender says that you can't breach 6.4% for a home loan, they can try to work anywhere within that ballpark from 3.9 to 6.8%. Now, having worked in the conveyancing space, I can personally tell you that many people don't even understand what the home loan rate is generally. They don't calculate it, and most people aren't even aware of what the market standard is, and they're more than happy in the most cases, especially if they're going through the broker, just to get the loan through. And with many of them coming in with a 10% deposit, getting a home and fulfilling that Australian dream is the best that they could ask for. So if I was a broker, I was able to get them their loan, that's their objective met. They might be paying a 4.6%, but hey, you know what? They've got the home now. The report refers to that many brokers were doing that to receive the highest commission, and I don't blame them. They have families to feed as well, but it's at the detriment of the borrowers who are borrowing that money and having to make those repayments. Now, this is something that the commissioner wanted to have removed as a whole, and you can understand why. There'd be many young families who go into a home loan not knowing what the standard rates are, but then paying at a much higher rate just to ensure that their loan's being pushed through. And now to add on to that, another point that the reports put out is that the banks are relying on the retail dealer. So what do they mean in this scenario? So in this scenario, they're referring to mortgage brokers and, in many instances, borrowers who are lying about their financial circumstances, so how much money they might have, and their expenses. More so their expenses, because you can see a bank statement for what it is. And then sending those documents through to get the loan approved. And this is because in general, in conveyancing, there's only two reasons why a contract will fall out. First is the building and pest. As long as most people are happy with the building and pest, which you can negotiate on the price on, things should proceed smoothly. But the biggest one people get caught up on is finance. Now, if loans aren't approved, then the contract can be terminated, and it's at no fault to the buyer, apart from the costs that they've accumulated up to that phase. But it costs the mortgage broker and the other parties a fair bit of time and money. And so it's within the interest of the broker, and I guess the buyer as well, because they want the home, to actually write the loan and provide any documents that are necessary to get that loan through. And again, I've seen this happen before. Sometimes the borrowers are actually falsifying the documents, not the mortgage brokers. So I wouldn't put 100% blame on the mortgage brokers to falsify the borrower's position and then providing that ultimately to the bank to get the loan approved. Now, the next consideration that the report refers to is the fact that mortgage brokers provide a service, and therefore they should be paid a fee by the person who the service is provided to. Now, you can compare this to any type of service that you've been provided, and if you think about it from any other perspective, it's kind of weird that somebody else pays the individual you're seeking services from a commission up front. So for example, if you went to a mechanic, I wouldn't expect that Toyota pay the mechanic a commission to tell me to use certain parts or to tell me to do certain things or buy certain cars, right? I pay the mechanic a fee and I expect them to service the car accordingly. So then the mechanic has the obligation to act within my best interest. Whether that happens or not, look. And so to add on to the previous point, if you're constantly having this conflicted remuneration that the brokers are subject to because the banks are paying them, they're now going to be overcome by human biases, and obviously to promote the products that best remunerates them accordingly for their time. And remember, this isn't to point at any particular fingers at brokers, but the report just leads to the fact that, they're humans as well. There's human psychology involved into all of this. You've got a borrower that really wants a home, no matter what. They're ecstatic to get their first home, to get the loan through. They just want the home, and I've seen this myself. I've seen this happen in the office. They want to get it through, and you've got a broker on the other side trying to broker a deal. Smaller banks might not take them because it's too risky, but the larger banks, they might take them on despite their lack of financial ability to do so. And so eventually a broker might be able to justify to themselves that, hey, this loan's all right, I can write this, and what I'm providing is a win-win situation. I get a high commission and they get the loan pushed through. I get it. And this is going to be a competing force as long as we have lenders paying for the commissions. And for the last consideration in this recommendation is that many have argued that there might be a reduction in the brokering services because people are less likely to pay for their fees up front. And you can imagine, somebody who's just scraped a 10 to 20% deposit isn't very likely to pay an extra $1,000 to $2,000 for a brokering service that they were receiving for free. The other argument that's been brought forth is that lenders were a channel for smaller brokers to get through to borrowers that were in need of the service. And with many brokers likely to leave the sector, you can see why many would argue that the big four would dominate the market even further. Now, of course, this is something that the ACCC would look into in making sure that there's competitive rates within the marketplace. Now, the Commission touched on this and mentioned that borrowers actually liked using the services of brokers, and I can attest to that just from personal practice. However, the second point that they bring up is that the cost of the brokering services can always be capitalized in the loan and repaid over the life of a loan. In this instance, we need to note that this is much different from a trailing commission. Although the fee is tacked onto the loan, the broker isn't actually receiving a portion of what the loan amount actually is, in addition to what they might be receiving in flex commissions. So in the fight for a more competitive market, what ASIC has actually found is that the smaller lenders were less likely to actually remunerate, have access to the brokers as opposed to the larger lenders. So any goodwill in terms of competition and whatnot has absolutely been undone. And at this point, the lenders are less likely to go and try to find and fight for better rates. Instead, they're going to try to fight for better commissions to access the brokers, because those are now the channels for borrowers to come on in and purchase the products. Now, I could go on for a while with the for and against arguments that this report's brought up, and I'm only in the first volume, right? It's rather extensive, but I think my thoughts on it overall is that it actually hasn't achieved any changes. Instead, it's actually just given the banks a slap on the hand, inflicted off to the brokers who actually initiate these loan applications and then filter it through. Now, in a market where you're going to have less brokers, there's obviously going to be a need for a simplified process for applying for loans. Now, this is where I can see the online banks like ING, ME Bank, or banks without a branch in the major cities to step up and provide some digitized version that can walk individuals step by step and cut out the middleman in between all of that. And personally for me, I've always seen the purchasing of property as just a chain of middlemen. You have your real estate agent, who then after receiving the contract goes to the solicitors. There's two solicitors now. One is looking after the banks only for the seller. The other one's looking after the building and pest and the banks. And then within the banks getting the loans, there's a whole bunch of other chains and documents that need to be submitted. So it's just quite convoluted in terms of how many middlemen you need to actually get the purchase from A to B and complete the whole transaction. And throughout this whole time, people are making money all along the way whilst you're making the transaction and making the purchase. And as you can understand, the reaction of the market after this week report was rather positive. All the banks went up the following day. Now, NAB was one of the banks that were really singled out in this whole report. And consequently, today, as of Friday, the 8th of February, the chief executive has actually resigned. And NAB shares has actually fallen down. Now, personally, as an investor, to reflect on this whole report and the commission that's gone through the whole thing, I wasn't really too worried about it, to be honest. And that's why I dumped about $5,000 into Westpac shares as they were going down. Because you have to think about it. If you read the annual reports, most of these banks were making a profit. They were easily making a profit. And what was the issue was that people weren't able to pay back the loans. But as part of the banking system and as part of lending out money, there are going to be individuals who can't pay back loans. And I think Matt Common in one of his interviews actually touched on the base that all banks are aware of like a possible 5 to 8% default on many of the loans. And that's a given. But if they're not giving out loans, then they're not actually providing the services at all. And so for me, if you understand economics and if you understand the long run, no matter what, I think the financial sector will not be touched. And given that I've mentioned before that Australia has one of the most stable lending structures, I don't see it being changed drastically at all. And I see the banks going up and paying out their dividends as is. So thanks so much guys for watching this video. I hope you really enjoyed it. I tried to make it as concise as possible. I'm still new to this, so still trying to figure out how I want to cut the videos and do all of that. It was a long read through. I think I got through about 150 pages of the report, and it highlighted what I could and tried to summarize it so it's easily digestible for everybody out there. Let me know what you want me to talk about below. Let me know your thoughts about the commission, and I'll see you in the next video. Bye.